Hello everyone, welcome back to my channel, The Learning Path. This is Dr. B. Meena, Associate Professor and Research Supervisor from Petition College of Arts and Science, ARR, Chennai. In this video, I'm going to teach you one of the traditional method followed in capital budgeting techniques is ARR, that is Accounting Rate of Return method, or otherwise known as Accounting Rate of Return or Average Rate of Return on Original Investment, and as well as average investment methods. And before we are going to calculate the ARR, let me check the preliminary steps to follow. First of all, we need to calculate profits after tax and after depreciation. In all other methods, we used to calculate the cash inflow, I mean the annual cash inflows. We calculated profits after tax but before depreciation. We add depreciation in the last step. But in this method only, we are going to calculate profits after tax as well as after depreciation. So first we deduct the depreciation, then deduct the taxation. The answer is called it as profits after tax and after depreciation. For each and every year, we will calculate it. Then we need to work out this format. In one column, we return all the years, first year, second year, third year, fourth year, fifth year, whatever, how many years they given, please mention like that. Then second column, profits after tax and after depreciation, the respective years, profits after tax and after depreciation that we calculated in the, as per the previous slide format, we just substituted here and calculate the total profits after tax and after depreciation all the years. Once you calculate the total profits after tax and after depreciation, calculate the average profit after tax. How to calculate it? That is total profits after tax and after depreciation divided by the number of years. In case if you have a 3 years profit means divided by 3. If you have 4 years profit mean divided by 4. If you have 5 years profit mean divided by 5. That is the way how to calculate the average profits after tax and after depreciation. Once you calculated average profits after tax and after depreciation, then move on to the calculation part of the average investment. In case if the problem has the scrap value for the investment, deduct the scrap value from the investment and divide by 2 because we are calculating average investment. Once you calculate the average investment, then finally we can make a move on how to calculate the ARR either on the original investment method or on the average investment method. In case original investment method means the average profits after tax and after depreciation divided by investment minus scrap value into 100 because ARR is always mentioned in the percentage format. Then under average investment method divided by average investment into 100. That is the thing we need to follow under ARR method. Let me discuss one problem and you may have a more understanding under ARR method. A project requires an investment of rupees 5 lakhs. So investment cost is how much? 5 lakhs. The scrap value is given as 20,000 after 5 years. It is expected to yield profits after tax and depreciation. So the question itself, we have a ready-made answers, profits after tax as well as after depreciation only. So only job we need to calculate the total profits of all this 5 years profit. Then divided by 5 years, that gives you average profits after tax and after depreciation. Then we need to work out what is the average investment. How to calculate the average investment? The investment 5 lakhs minus scrap value 20,000 divided by 5 years will get what is divided by 2 will get a what is the average investment. Just check out the slide. You may get a more idea about how to do the workings. First year, second year, third year, fourth year, and fifth year, the respective year profits as per the problem, we substituted here and then get the total profits after tax and depreciation that comes around 2,40,000. So average profits after tax and after depreciation divided by how many years profit were given? 5 years. So divided by 5 years, that gives you 48,000. This is average profit after tax and after depreciation. The second working notes we need to do the average investment. The average investment we calculate by this formula, investment minus scrap value divided by 2. So investment as per this problem is once again 5 lakhs and scrap value is 20,000. So 5 lakhs minus 20,000, that gives 4 lakh 80. 4 lakh 80 divided by 2, that gives you final answer 2 lakh 40,000 as average investment. Then we can able to calculate ARR on both the methods. That is, first method, original investment method, apply this formula: average profits after tax and after depreciation divided by investment minus scrap value into 100. So 48,000, which is the average profits, I substituted here, divided by 5 lakhs is the investment value, minus scrap value is 20,000. So into 100. So 48,000 divided by 4 lakh 80,000 into 100, simplify it and get the percentage and of ARR under original investment method is 10%. Likewise, I will calculate ARR on average investment method by using this formula: average profit after tax and after depreciation divided by average investment into 100. So 48,000 divided by 2,40,000 is the average investment that I already done the calculation. Then substituted here 48,000 divided by 2,40,000 into 100, that gives me 20%. So this is a way of working out ARR under traditional methods. This is one of the method how to calculate the take a decision for project proposals. Thanks for watching my video. See you again next video. Click the bell button to subscribe my channel, like and share the videos to your friends.